This is your last chance. After this, there is no turning back. You take the blue pill, the story ends. You wake up in your bed and believe whatever you want to believe. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
1.7% here, lost.
We're red everywhere, essentially, down by 4-5%.
Worst day on Wall Street since the crash of 1987.
Remember, all I'm offering is the truth, nothing more. Follow me.
What is going on YouTube? It's Brendan for Market Makers. I hope everybody had a fantastic weekend. Guys, this is an important video because we're going to talk about what the billionaires are doing. The smart investors, the investors that make their living and have made billions of dollars trading this market, and everything is showing in their own words, as well as what we're seeing in the data, that they are exiting the market. So we're going to cover that. I have some great clips to play for you guys. We're going to talk about what that means for the market and what they're looking at, as well as go over our normal TA. What is it going to do with Bitcoin? What's happening with the equity space and some individual stocks as well. So guys, please do take a moment, like and subscribe to this channel. We are almost at 30,000 subs. We're like 20 subs away. Get us over that hump of 30,000, helps us in the algorithm. Smash the like button. Let's go ahead and talk about this. All right, guys. On my screen, you see the S&P log scale monthly time frame. I want to show you something because as traders and as YouTube TA people, we get consumed with this, right? Can we take out the all-time high? Can the market move up 10%, 10.5%, take up the all-time high? But what is the big money doing? Lee, go ahead and throw that first screenshot up. Berkshire Hathaway, Warren Buffett, who's widely considered one of the most brilliant investors of all time. Look at what he's doing. Berkshire cash pile hits all-time high, 157 billion, as Buffett sells a record 38 billion stocks in the last year. What's Jamie Dimon doing? Jamie Dimon just sold 140 million or plans to sell 140 million in stocks for the first time ever as CEO of JP Morgan since 2005. His first stock sale ever. I mean, you want to guess why this is happening? But what's Paul Tudor Jones, billionaire, liberal, big liberal donor, billionaire investor? What's he talking about with stocks? He says he doesn't like stocks right now. He says he doesn't like the equity risk premium. And what does he think about the recession? Lee, roll the clip.
So it doesn't matter what the Federal Reserve says at this point. They've lost control. This is going to be the bond market talking and setting.
Yeah, the bond market. So what's happening is, and why we're probably going to go into recession sometime in the first quarter of next year, probably because the bond market, simply through supply and demand, is going to deliver more rate hikes because we don't have a clearing price yet for long-term debt. And so those rate hikes are probably going to tip us into recession.
That's right, guys. The recession's right around the corner. Could be right here. Is it just Paul Tudor Jones that sees it? Is it just Jeremy Grantham? Is it just Ray Dalio? Is it just Stan Druckenmiller, who says no new highs in the market for the next decade? Is it Leon Cooperman, who I played you clips of before? All billionaire investors. Leon Cooperman saying he thinks the next 7 years there'll be no new highs. The big money is exiting the market. Big players in the market, like Michael Burry, who's famous for The Big Short, is short the market. So we have to keep this in mind when you're looking at your charts. This 10%, yes, that will be great if you can get that on an up move. But what are they looking at? They're looking at the historical norms of being in a recession. What does that mean in a historical norm if the market enters a recession, which, guys, nothing is certain in life, but you're talking about a 99% probability you have a recession if it hasn't hit already. So the historical norm is the market to trade down 33% from its all-time high. You're looking at 3,200 on the S&P. They're looking at that. And if you're forecasting this, is this a bubble? Is this like 2008? Is this like .com? We know the metrics for these bubbles. Then you're looking at a minimum of a 50% decline, as you can see on my screen, harmonic contraction back to the 1618 at 2417. My personal target is 2000. Jeremy Grantham lowered his target from 2400. Not a coincidence, by the way. Jeremy Grantham picked 2400 and now he lowered it to 2000. Guys, bubbles have historical precedent. The markets move from bubble to bubble, okay? And when the market realizes it, it's too late. That's when you get the Minsky moment of massive selling. This is why the billionaires, the Warren Buffetts, the Jamie Dimons, the Druckenmillers, this is why they don't care where they exit. They're exiting in the uptrend trend. They're selling into strength. It's very important to understand this. The leading economic indicators printed their 16th consecutive negative month. What does that mean? It means the economy's bad, guys. The last time we had a streak that long was the GFC, the Great Financial Crisis. We have the yield curve inversion, the strongest and longest in duration ever in the history of the market. You have all the leading economic indicators telling you that the market is going to crater, but yet on YouTube, we obsess with, can we go up a couple hundred points? Now, I'm going to show you how I'm trading this market, but you got to keep the bigger picture in mind, guys. The bigger picture is the 50% or at a minimum, a 33% drawdown from the all-time high. You're talking about 1,100 points lower, 1,200 points lower than you are right now at a minimum, just to do what the market has done every single recession. 1,200 points lower. And that's assuming we're not going to rally up any more than we are. But guys, they're starting to talk about this now on mainstream media as well. The narrative will switch. As Jeremy Grantham was saying earlier in the year, as the year progresses, as the recession draws closer, the narrative will switch and they'll start openly talking about how bad the economy actually is. You guys know we had these 3 job prints, the Fed numbers, right? The 3 job prints, the last 3 job prints, and the last one prior to this 180,000 that we got when you add in the striking workers. Prior to that, we had 336,000, but those are majority part-time jobs, and these are government numbers. I want to play an interesting clip for you because, as you guys know, over the last 3 job prints, we've lost 653,000 full-time jobs, according to the government numbers. All their numbers come out hot, and then they get revised down, but they get revised down months later. We lost 653,000 full-time jobs. That's only happened 3 times in history. When? It happened in the pandemic, the GFC, and .com. The writing's on the wall. A lot of this is about wealth preservation, and people need to understand that because people get destroyed in these markets. I saw it firsthand in the GFC, working at Merrill Lynch, and I saw it in .com when I first started trading myself. I've been through 2 of these cycles. They repeat. Guys, listen to this clip. It's a couple minutes. I want to play it for you, and we're going to talk about it on the other side.
I don't think it's an accident that every time you and I do the show together, the market goes up. Have you noticed that?
Look.
It's
now
it.
we know what to do.
There we go. Let's do it. What are you telling your clients? Are you shocked by this rally?
I'm not shocked by this rally, but I'm not sure how much longer we have to go. The employment report that we saw today, to me, is a pretty clear signal that the last of our economic dominoes are beginning to topple. It means we probably have a couple more months of this resilient economic data that we've been seeing, a little bit of edge off the Fed that I think could be supportive to stocks. But it really is a tactical improvement from our perspective with recession right around the corner.
So, okay, recession right around the corner, because I posted this on X, formerly known as Twitter. I thought today's jobs number was terrible. And the headline number, I don't watch. I look at the household survey. 384,000 decline on the household side and revisions downward. How do we read this?
Yeah, it's a tough number, but it's not a one-off. In fact,
no, every jobs number gets revised down almost every month.
And other data we're seeing: continuing claims, the productivity-related employment data, temporary joblessness. These are all figures that have been pointing in the same direction. And that's important because, we're right on time. The Fed's lagged impact of monetary policy usually takes 18 to 24 months. We're about at 20. This is exactly what we would expect to see. And historically speaking, when you start to see this type of early softening in employment, it accelerates pretty quickly.
Well, I brought this up with Bill Gross last night on Last Call, and I said to him, I said, I'm not putting on the tinfoil hat or anything, but sometimes the government data doesn't always match up with maybe what your ears and eyes see or people tell you about it. We just had a 4.6% GDP print. So I'm hearing you say you're a little bit concerned, but the macro government data shows that it's the greatest economy in the history of the world.
Well, look, first of all, I think you'd look amazing in a tinfoil hat. I think you should consider that
Reynolds, like, are we going cheap
as a
here?
fashion choice. Just saying. But what you're describing is really a matter of leads and lags. the economy has been evolving over the last 18 months, really, since the Fed started hiking rates, the way we would expect it to evolve. And the Q3 GDP data doesn't tell us anything about the way employment's going to evolve in the next couple of months.
Yeah, and another cheap plug for last call, because I'm here, so we're going to do it. We asked about, so it was Apollo Investments came out with a really interesting chart and basically said based on earnings yield of stocks against the 10-year yield, Apollo felt that the U.S. equity market, the S&P 500, was the most overvalued in 20 years on that one metric.
So you can see the host. I actually like that host, and Lauren Goodwin. I want to have her on my podcast because, yeah, I think she'd be fun to talk to, and she's nice to look at as well, right? So I would love to have her on. But guys, what are they saying? Minus 348,000 jobs in the household survey, much more accurate than the government numbers. You don't have a minus 348,000 jobs in the household survey. You very likely could be in the recession right now. And just keep in mind, for everybody that's waiting for the government to tell you when you're in a recession, waiting for the Fed to tell you, the National Economic Research Council, NERC, I believe it's called, took 9 months after the GFC, 9 months to tell you when the recession started. The recession started in December of 2008, and it wasn't until 9 months later, maybe it was 2007, maybe it wasn't until 9 months later they told you that the recession actually started 9 months earlier. Okay, so if you're waiting for the government, you're waiting much too long. You have to understand what's happening in the marketplace. The economy is crumbling. Markets are moving up only because all their focus from mainstream media, their focus from everything else is to keep people invested in the market. And all their focus is on is Powell done raising. Now, we know why now Powell was very dovish at this last meeting. Why was he dovish? Because he saw these same numbers. The household survey, minus 348,000, the economy, the leading economic indicators, the manufacturing ISM at 46.7, back at pandemic lows. The economy is slowing. And what the average person doesn't understand is these lags. It's going to get worse. It's not going to get better. And there will be a Minsky moment when the market realizes it and everything starts falling very fast. Markets fall 3 to 5 times faster than they rise. So your bullish case, looking here on my screen, your bullish case is to take out that pivot high, your 4607, and guess what you'd be doing at that point, guys? You'd just be making your W. You see this on the monthly time frame. You'd be making your W pattern to rally up, knock out your all-time high. Okay, that's the bullish case. What could price also be doing here on the monthly time frame? We'll look at this as well on the S&P, just coming up for a double top. That's all you could be doing right here. It says what you did over here at your first all-time high, lower high market breakdown. Okay, so it's a very binary inflection point. The question is, how quickly will the economy give out? There's some big things happening this week. Guys, if you want to understand how to trade these markets, you have to look at the whole market holistically. We have bond auctions coming on Tuesday, Wednesday, Thursday. Wednesday, Thursday at 1 p.m. Eastern being the most important ones. The 10-year at 1 p.m., the 30-year on Thursday at 1 p.m. Those 2 days, Wednesday and Thursday, watch right around 1 p.m. The markets are going to move up or they're going to dump because we have a lot more supply. I think 40% more supply than normal than this time last year because of all the debt we have to monetize. So yields will have to rise if nobody buys the debt. Conversely, debt gets bought up, no problem. You could see the markets pop up. Understand the resistance levels. We're going to go over all of that on the show today, guys. And you want to trade these markets, check out our fantastic sponsor, SimpleFX. With our link exclusively, you do get up to a $5,000 first-time deposit bonus. It helps support the channel. Check them out. All right, guys, that's SimpleFX. And of course, if you want to trade all of the cryptos and not use a VPN, I always recommend using a VPN to protect your privacy, but not use a VPN. Check out BingX, fantastic crypto exchange. Both of those exchanges get you a free month in our room. To get that month, message Lee in the Telegram or message us on X. Lee in the Telegram, all that information is in the video description. All right, so let's go ahead and move forward and check this out. So continuing on this theme about the government lying to you, I just want to share this with you guys. This is Trueflation website. another way you can measure inflation is not this bullshit 3.7% the Fed gives you. And then the Fed looks at core, right? What does core do? Strips out energy, strips out food, two essential ingredients to living, right? But they keep stripping things out. They use really, it's called hedonics. They use all these different measuring systems for how to calculate the CPI. It's bullshit. You know what the easiest way is? Look at how much the dollar, as far as purchasing power, has fallen since January 2020. 24% almost, 23.81%. So when you go to the grocery store and you're like, man, this isn't 3% inflation, this isn't 4% inflation, understand, and we talk about this all the time, inflation is compounding. So when you had that 9% inflation move, and then you had that followed by 5%, 6%, 4%, it's aggregated, it's compounding. Prices don't come down, it keeps moving up. So the dollar, the effect here of the dollar is you're losing 24% of your purchasing power, which is why it seems like groceries cost 20+% more, right? So nobody will tell you this. The government doesn't want you to know this. What they're trying to do is not stop inflation. They're trying to slow the rate of inflation down to their 2% number. But that means all the prices that went up would stay at that level. There's nothing to tell you those prices would come down, because why? Because they want inflation to be continually 2% so they can monetize future debts. This is the economy. This is how all the Western world economies work. They are debt-based systems, right? So the best thing for the consumer is a recession, because you will get deflation. Prices will come down as demand comes down, as the money supply contracts. You want these prices to reset. You don't want your groceries to be 20% higher this year, and next year or the year after, if they're able to get inflation down to 3% or 2%, just keep going up 2%, 3%, because most people aren't getting 5% raises every single year. They just don't. And this is why this hurts so much. And this is why it hurts the lowest income people the most. And this is why the government doesn't talk about this number, your purchasing power. They don't talk about aggregate inflation. They focus on year over year and month over month to just give you two numbers. Look, guys, 4%. Now 3.9. Isn't that a great improvement? No, because it's building on already elevated prices. That's what they don't want you to know. Let's check out the VIX. VIX dropped down to 1510 after Powell. And after Powell, another thing I want to comment on, I had a couple people on the YouTube, a couple people on X comment, a couple of people on Discord. They didn't think Powell was very dovish, right? Because I said he was dovish. But I want to comment on that because my reply to them was, it doesn't matter what you think. It doesn't matter what I think. It matters what the market thinks. And you don't have a rip-roaring rally, the best week in the market for the whole year, because they thought Powell was hawkish. You don't have yields fall because they thought Powell was hawkish. Yields fell, DXY fell, market rallied because the market, again, it matters what the market thinks. The millions and tens of millions of people trading in this took it as a dovish pause that the Fed is actually done. And the Fed may actually be done. I don't think they are. I think they're going to end up having to raise again, and they're raising into a recession, which is catastrophic, historically speaking. 10-year bouncing back up a little bit, 4.641. Again, where you're going to see this move, the 10-year, watch Wednesday. That's the auction for the 10-year. And if it goes poorly, I think you're going to be right back up here, 4.7, 4.8, right in this range. Another thing to watch with yields, guys, played you the video clip before. If this was the peak, if this 5.021 was the peak of the 10-year, back in the GFC, 13 weeks later, you had the peak in the markets, then they cratered with the yields. They followed the yields down. Back in .com, which was an equities bubble, which is what you have now, in Confluence, in addition to having a housing bubble, which the GFC was. But back in .com, you had the yields peak. 7 weeks later, the markets peaked, and then they followed the yields down. Okay, it's a cycle that repeats. The timing can vary, 7 weeks, 13 weeks. But if that's the peak in yields, then the countdown clock is on. If the yields come back up, then the countdown clock has not started yet. But eventually, when yields crater, why will they crater? A, people will be buying bonds, risk off, and B, yields come down when the economy substantially weakens. Markets follow suit. markets follow late because that most people involved in the markets have zero idea what's going on. That's why it is important to understand the billionaire complex that does understand what's going on, and they're telling you what's going on, and you can see it in their plays in the marketplace. Why is Warren Buffett sitting on $157 billion when he just had a fantastic year with his companies? Why? Because he wants to buy the market substantially lower. Long-term investing, doesn't care if the market goes up 200 more points. He wants to buy it when it's 1,000, 1,500, 2,000 points lower. That's how you get to be a billionaire, everybody. So looking at the DXY is still weak. Again, we're going to watch this for Wednesday, Thursday, see what happens. It's just sitting in place. Moving forward, looking at the Dow, the baby S&P got above the 200, got above the 50. You're hitting fractal here, fractal resistance right here. You can look at this from a FIB perspective, 34,159. Haven't taken that fractal out yet. What's interesting in the markets on the daily, on both the S&P, the Dow, and the NASDAQ, you're not overbought, right? But if you start scrolling down through the time frames, look at your 8-hour, you pretty much almost hit overbought. In the S&P, you hit overbought. We'll look at that in a second. 4-hour, you're way overbought. Like, I think you got up to a 96 rating. Okay, so you can see the candles here just stacking sideways. We'll see what happens, guys. This, I don't track the markets based off the Dow. I do it based off the S&P, but there seems to be a pretty strong wall, 4,400, 4,416. So we're going to talk about that. But as far as the DJI, the baby S&P, let's go back to our daily here and look at this. Resistance wise, you came right back up to whence you fell before. Okay, so this is a 100% retracement from this move. You can see this is a natural doubling and halving in the marketplace. 34,159, hit it. If you can flip this and get on top of it, take out that fractal high, I would be looking for a rally back up to 34.6 and 35.3. Do I think it's likely? I think it all depends what happens with the bonds. If it's a great auction, you're going to see yields drop, and what's going to happen? Binary reaction in the market, day traders, zero-day option traders, you're going to see people buying the market. Yes, Santa Claus rally, and it comes back up. But that's what I'm looking at for the next move. If it holds out and the yields have to rise, I think you're going to see this retrace and get a retracement in all the marketplaces. Again, S&P on the monthly, guys, I keep showing you this because you have to understand these patterns that present themselves. And just from two perspectives, we talked about this from your all-time high. Looking at your fib, you could come up to 44.97 at the 786. That's 4,500, right? That to me would be that upside target in a large time frame. But that doesn't have to be where you get to. We already know 4,400 based on our last short gave us a 300 bar drop, a 6% move in the market, and we're right back in that range again. And when you look at this on the monthly time frame, just from your rally high here to your low, you have that 44.07 at the 618, and you're at 43.64, right in between on the monthly time frame. And you could easily be just coming up to do one of these before you descend. The same thing you did on the monthly at the previous all-time high. Okay, so showed you that pattern, showed you had this could turn into a W pattern. You have to take out that fractal, the high of the rally at 46.07, and then you get your W pattern, and then you'd be looking at that rally, which is what a lot of people want, right? A lot of people want that rally more to the upside. Maybe 49.50 is what your target would be there on that W pattern. But you got a lot of work to do, and the economy is quickly decaying, and people, more importantly, more and more people are realizing it. Okay, let's go ahead and look at the S&P. Again, looking at this big fractal pattern that we have here. Part of the reason I don't think we're taking out the rally high is the fractal pattern. 201 bars from the high, all-time high, to your market low, and then the next leg, 203 bars, as you can see, from your market low to your 4,600 high, and your next leg will take you down to May 2024, May 6th, and at that point, guys, the market will be at a hard bottom. Could that just be the pull down to 3,200? Maybe, and that's your 33% drawdown. Could it be we get to 3,200 faster than that, bounce up, rally, and then our true bottom down there? Maybe. Again, it's a forecast. What I do know is this is market symmetry, okay? I know this is calling for a decline between the rally high all the way out to May. How quickly we decline depends on a lot of factors, two world conflicts. What does Powell do? Does Powell have to raise again? That will speed up the decline. Does Powell stay on a pause? So all of these things matter as they unfold, but market symmetry tells me we're in a downward decline until May 6th, okay? That's the market symmetry based off this fractal pattern. And so that's helping me make my decisions here in the marketplace. Again, the way I think this could play out, this is really interesting to me. You guys know we've covered the lunar cycles. I intended to cover the solar cycles today. I'll do them on Thursday's video. They're not affecting anything at the moment anyways, but just for education purposes, I wanted to talk about what the billionaires are doing because that is affecting how I'm viewing the marketplace, seeing how many of these big traders are exiting the marketplace. But when you look at this here on the lunar pattern, again, new moon is November 13th. If we get these higher yields, you could see this play out on the daily, right? Higher yields, market comes down. Market gets bought back up. Retail wants to buy it back up again. Come back up, make your second top, new moon, thereabouts, November 13th, somewhere in that range. And what did you do? The exact same trade, our rinse and repeat trade we did on the previous trade, right? Look at this, full moon, wave down, new moon, second top, boom, wave down. You could see that exact thing play out again. Or again, bullish situation, yields drop because the auction goes well, market rallies back up. That could be your first top, then your sell off, then your second top. Not saying this has to happen, guys. I've just showed you many examples in trend where this literally happened, okay? So I'm looking at November 13th, November 27th, but we'll see how these yields play out this week. Very important bond auction. From a trading perspective, I'm short below 4,400, guys. We traded this in the room, posted a trade. I told you exact same rinse and repeat trade. Where do we pump to? We pumped to 43.75. Some guys are able to get in here at the exact top, but to me, this is a very easy trade to take because I know if we start closing above 4,400, breaking above 4,400, well, then very likely the market's going to continue to rally, okay? If we start getting daily closes up above 4,400, easy exit point. We got a 300-point drop. If we take this trade and lose 25, 30 points on a stop loss, again, it's all about minimizing the damages to your account, maximizing your gains. 300-point gain, 25-point loss. But conversely, if the trade works out, you're getting the same exact trade again. So that's how I'm trading this, watching this to 4,400. And of course, if we went ahead and pulled this from the rally high, you could see 44.16 would be the actual 618, right? Right at the apex of the channels. Could we wave up and then wave down? I think it's very possible. I think you're going to double top out, whether it's up here at 44.16 or below 4,400. I know with options, there's a big call wall at 4,400 as the economy starts to decay, euphoric rise. Let's look at this on let's get our indicator on here. Let's get our MFI on here. And looking at this on the daily, like I said, you have your double bottom structure. You're still in the bearish territory. But when you start scrolling through here, 8 hour, massively overbought. You have to go back to the bull run starting, right? To find an overbought reading like that from this wave up we had this past week. Looking at the 4 hour, again, this is going to be massively overbought. If it wants to go ahead to populate, there we go, massively overbought. So the market's waiting, and people are wondering, what is it waiting for? It's waiting to see how these bond auctions go, guys. It's waiting to see how these bond auctions go because that sent the market down last time, right around that 1 o'clock, 110. Just watch what happens in the market. You're going to see it rise up or you're going to see it start selling off. And then look at the 10-year. 10 years rising up, you're going to see the market start pulling down. But to me, the rally doesn't really have much legs to stand on. It's euphoria. Doesn't mean that it can't go higher. Euphoric rallies can go higher. You can have fewer people paying higher prices. But when you look at the billionaire class, when you look at the TA, and when you look at the way the market, the actual economy is presenting itself, guys, it's very, very bearish what's coming out in the economic factor. Doesn't mean the market can't go higher because the market is speculation, but the economy is very real. How's this affecting Bitcoin? Bitcoin's at 35K, and we got all the way up to, what was this, 36K? Do you remember my chart, guys? I had the symmetrical waves. I think that symmetrical wave would take us to 39. Obviously, with having more candles, we have that 41K target. Now, what I don't like about Bitcoin, I gave you this tight range that it's trading in, and that's actually the very bottom candle. You can go to this fractal here and really tighten this range even more, and that would be 33.3 and 35.321. You see this? But what I don't like on the daily time frame, after exiting our diamond, right? This is our 11% trade, the trade I shared with you guys to break this fractal, capture this 11% move. if you just threw a trend line down on this like this, right, you can see you have this upward angle of price. Now, when you start looking at this, you're getting divergence in the money flow. So you made a double top in the money flow, and this was your high, right? This was your high in the money flow right here at this fractal, and you can see it right here. Then you came down, which is good, but then you made a higher high, lower high in the MFI, and the MFI is just dumping here on the daily down to the median line as price is still drifting higher. You're building bearish divergence. That's something very important to monitor. Doesn't mean you can't retrace some and rip up to the upside, but it's important to monitor because you start finding trade confluence. So if the markets start rolling down, I'm telling you this, because if the markets start rolling down on, well, it was Tuesday's a 3-year auction. I don't think that's as important, but if you notice the market weakening Tuesday, if you notice it weakening a lot Wednesday and Thursday, the 10-year and 30-year, those are the two big ones. This is building bearish divergence. Okay. So this could be a couple of things. This can be price going up, come back for a pullback, and then wants to come back up again and make that W pattern, right? This type of move here in the marketplace, or this could be price going up, starts drifting back down, and then just waves softly back up, and you start doing that, and you have your double top pattern. You want to see how Bitcoin behaves. I don't like the fact that you're getting bearish divergence right now, and you're kind of, you're in an uptrend. This would be fine to have bearish MFI if price was behaving normally, moving up, moving down, chopping around, an accumulation pattern, right? Making some higher lows. That's fine. Like what you did here, this was a topping pattern, lower lows, lower highs, lower lows, lower highs, and then you fell down. And you don't want to start seeing this bearish divergence play out here because that's what played out here on Bitcoin. Look, there's your top, right? Right here's your top. And then what happened? MFI got weaker, started making lower lows. Price kept going sideways, making higher highs. And then what happened to price? It started to fall down. Okay. So this is a leading indicator of the MFI. It's a volume weighted RSI. I would start looking at this and see how this plays out in accordance to price, because right now they're diverging on an important time frame, which is the daily. But again, I'm going to look at this with the catalyst of the markets. Okay. That 41K target is still on the table. This is something you need to watch because the markets do start rolling back down, which they may not. But if they do, then you're going to see a bearish structure get printed, maybe some type of double top, or maybe just a succession of lower highs, lower lows before price gives out like it did last time it did a topping structure. Okay. So pay attention to that, guys. Looking at the NASDAQ pumped up beautifully, just close to the top of the channel again, right? So that's what the NASDAQ did. Again, big euphoric moves, didn't quite get 100% retracement. Let's look at this from the rally high. From the rally high, we're here. Let's go down to the low here, almost to the 618 at 15,220. So it's 100 points away. 80 points away. Could the NASDAQ come up here and hit it right at the top of the channel? Of course it could. But importantly, what is the structure that it would have made at that juncture? It would have made a double top if it fails. Okay. The same exact pattern the NASDAQ's done twice before. You see how clean and clear cut these are? Your law of three pattern, right? So we'll see if that happens. Yields get lower, auction goes well, then look to see if this can break out of channel, flip 15,220 and move up. If it doesn't, you're going to start seeing this top make a double top most likely, like it did kind of like a half-ass double top here, but very clear double tops here. And you can see this roll back down to the downside. So binary event, Wednesday, Thursday, guys, watch out for that. Gold, gold pumped up to 2012, which is a 786 target. It's using as support 1969. It's chopping around, big impulse up, big fear trade. You had peak gold with peak inflation. You had peak gold with, I guess when the Fed was raising rates and gold flew up as well to fight inflation. So the two previous times you had that peak gold, or I guess the one previous time I really want to focus on was the 9% inflation rate, right? Back in May of 2023. That's when you had the big move up. And now you have the conflict, the war, and gold move back up. I think this is going to top, guys. And if you look at this from a larger perspective, you have a head and shoulders, or you can just look at it as a W pattern that's failing right here at the 786. Not in a hurry to trade gold because of the conflict. This can still move around, but let's see what happens. You're starting to build a structure here. And as you can see, gold can do this for a while. Okay. Gold can move around, build tops for a while. MFI coming down, price coming down. You have a double top forming here on the daily with your neckline essentially 1969. You see that? So it may just bounce back up off of it, come back in here, basically inside of a Wyckoff range between these two fibs. We'll just watch and see how it behaves as momentum starts to slow as well. If the markets really do start pulling down, gold could stay elevated, guys. Oil could stay elevated because of the conflicts. Okay, so that just keep that in mind. Looking at the FTSE, again, we shorted this up here, got a nice drop and moved back up with the US markets. And now it's just trying to base, right? You're trying to do this little J hook base here. You can see your W pattern here as well. Cover this all the time for you guys, but that's your breakout, right? And so you see your W, you're trying to hold this and then pivot back out to the upside. And this is the fractal you'd have to break 74.86. You'd have to see that break, but to get the 50 above you and you got the 200 above you, you are in a death cross. So all of this depends on the markets. And if the S&P can't break 44.16 and start moving above, I think you're just coming back down. I think you'll make a double top and I think you'll come back down here in the FTSE as well. Let's just look at that from a fib perspective. I'm going to take that second top high and you bounced right off the 486, 74.80, came back down trying to hold, what is it, 73.91, this trend line here on the fractal low, hold that for support, but that's your move in the FTSE, guys. If you want to see FTSE upside, you got to make this W. You got your spike here, you got to make this W to come back up, so you got to break that fractal high, 74.80, and come up, okay? And that can bring you back up in this range. If not, you're going to double top somewhere between around 74.80 and then come back down back into the lower fractal range and possibly come down and test 72.22. Looking at this on the French 40, exact same thing. You bounced up to the 486 fib, 70.85. You had your W form down here. And what you're doing now is selling off on the daily time frame perspective. And so you're going to do this. You're either going to come back up, make a lower high, try to hold your neckline. If not, that's your double top and you're coming down. Or you're going to do this, hold this and try to break out above that fractal and move back up, okay? And you see this pattern repeat on sell-offs all the time. You have your move down, here's your move up, sell off, failed, move back up, double top, fall back down, okay? So that's the levels you want to watch. 70.85 here on the French 40, 70.14 to try to hold a support. And if you lose that, guys, you could be moving back down towards 6,830. Right, that level right back down here. We can do this with a smaller fib as well. Go ahead and pull this, look at it like that. And you can see you're right at 70.14 on the 382. Below that is your other 382, 69.65, 618, 68.83. So you'd want to try to see if you can hold that. But this is a downward trend, right? Markets are trying to reverse. Doesn't look healthy. Europe in a recession, going into a recession, individual countries such as Germany already in a recession, strong inflation, not boding well going into 2024. Look at the DAX as well, big topping pattern, big rollover. DAX pumped up with the American markets, 15,136. You got just above 15,194, the smaller measurement here, just above the 618. Key resistance right here at your 50 at 15,359. Your 200, so you're in a death cross in the DAX. Your 200's higher up at 15,6. And if you start falling, exact same concept as the French 40, guys. If you start falling, you want to hold this pivot, which is 14,961, right? So if you fall down, you want to hold this pivot. And then you can base, try to come back up and break this fractal to rally to more upside, right? And if you don't fall, if you don't break to the upside, you're going to do something like this and make a lower high and start to descend again, just like you do in these trends, okay? It's really that simple, just watching these simple patterns form. The trick is what's going to trigger them, right? Things such as the bond auctions. You got to stay on top of the data coming in the marketplace. Tesla, same thing. I see a very small mini cough structure here on Tesla. You can see it's right here. Here's your base, right? You can see at the orange line. And then your reaction. And what's your price doing? You got a down thrust. You're trying to get back up here for a pivot, right? If you can get this pivot, break back up to the upside, fill this gap, maybe come up to 249, good target area for Tesla to potentially short with confluence of the markets topping. Right now, you just have a lopsided W pattern. You can see right here, here's your W, your low, your lower low, and you came back up, okay? And this may be it. maybe a little bit higher, but that may be it for Tesla. We'll see. And you bounced right off 192, so that's key support. And right now, your resistance that you're hitting, if we just take it from this high, this fractal high to this low, you're right at the 382 at 222. You're just below it at 219. 618's up at 240. Again, I like it up here at the 249. So maybe 240 to 250, that range for Tesla. See if we get a topping pattern if it decides to move up. If not, you're topping out right back here, right back at your neckline, right? Right back at your neckline. That's something important to see, guys, when you zoom out on the daily. You have this structure that you made, right? So you have your double top structure. As you guys know, we've been over this many, many times on Tesla. Massive double top. You broke down, you broke your fractal low, your neckline, right? And if you look at this from a Wyckoff perspective, look at the one fib right here at 217 as basically your base, right? Your base where a price came down to, down thrust it, rocketed it back up. And then what did you do? You came down, you broke out, made a lower low, and now you're trying to come back into your trading range. And if you come back into your trading range, whether it's 249 or lower, and you do something like this, you're just breaking down back in this box, your box that goes from 289 down to 217. So you're just making your high, your lower high, and again, another lower high law of three pattern. You could say it's a triple drive pattern at that point, and that would be your market breakdown. Okay. Just very simple concepts that repeat. The best quote unquote trading systems in the marketplace, guys, are just people that build on the existing trading systems. They try to modernize it, but I like the OG trading systems. I try to teach my Wyckoff the original Wyckoff way, not people's modified way, my Dow theory based off the original Dow writings, and trading waves the way that Charles Dow, Richard Wyckoff, W.D. Gann, and Elliott looked at waves, and Gartley, most importantly, as well. So that's how I try to develop my trading system. It's more conceptual, and it really helps me in the marketplace, but you see these things repeat over and over again. And guess what? You don't need to spend $3,000 to learn this stuff on somebody's website, okay? You can go buy a couple of trading books or join a website like ours, join a Discord trading group like ours, and you get all of this information in the Discord as part of your monthly membership, which is just basically the price of a cheap trading book. So check that out, guys, if you want to. Our links are in the video description. Let's skip race. I'll just show it to you. It gapped up again, so this is really good for a breakout of race, but I know a lot of people aren't that interested in trading Ferrari, so I don't want to spend too much time on it. We'll go over it when it starts making a pattern I want to trade. Adobe, though, is at 562. Why is this significant? The exact same levels. Right? So if 4,400 ends up holding on the S&P, what's it trading at now? It's at 43.63. If 4,400 ends up holding again, what do you guys think Adobe might do? I don't know. It might do this move again, right? This move again. So we'll watch. Adobe wants to break out to the upside. You have a very clear W. You got to take out this fractal at 574. But if you do, you can come up to that 608, 618 level. That's what I would like to see Adobe do, but it is going to be a prisoner to what the broader market does. And if the broader market starts topping out here in the next 8 days, that November 13th date, if you start seeing it top out with yields rising, Adobe is going to start coming down as well. And they don't have their earnings until what? December 13th. Okay. So still quite a ways away. Adobe will move with the markets. This will be a good one, guys, because this is one of those stocks I think is going to go down by half, right? 342 just takes you back down here right before the AI craze, or part of the before the AI craze back in the summer. When did the actual AI craze happen? What month would you say it was? Was it the summer? So right around there, but you can see the AI craze took Adobe way up. This looks like an elongated topping pattern if you do not get a breakout. Lots of wave moves up and down. You can see the waves. So this is something I'm watching very closely. Key resistance area, once again, at 560, guys, and this could end up rolling over once again. But what we do know that Adobe does here, when it does these rollovers, you can see, right? Three-wave pattern, double top. Up, down, up, lower high, double top. Got your up. Let's see if we get down. Let's see if we get a lower high. And that can be a trade right there with confluence of the markets rolling over. Third time's a charm. NVIDIA, their earnings are November 21st. So again, you got hung up at the 458 right here at the 786 fib. You have your high, your lower high, and you still have a third lower high. You have your low and a lower low, bearish trend, still in your Wyckoff trading range of 403 to 502. Trying to make this breakout, you have to break that fractal at 476 to give you a nice W pattern to come up to that 1618. Showing you that right here, X5 pattern, Fibonacci pattern, could look something just like this. That would be my target, 1618, 527. If you could break that fractal high. If not, you're in a downward trend. If the markets start rolling over again with your lower lows coming in, then you're going to see NVIDIA pull down with it. And it may get a nice rally if it has nice earnings, but it may be rallying from a lower number. And NVIDIA, another one to watch because it has the gap down here all the way at 300, and it has a long way this thing can come down when the AI bubble fully pops. And we already went over AMD. Nothing's really changed on that. Went up to the 46 at 112, got rejected. Strong downward trend still here on AMD, moving with the semis. All right, guys, I think that's all I want to cover today. Thursday's video will be the next video. Definitely like and subscribe. Consider checking out our trading room. Thank you, everybody, for joining today's video, and I'll answer all your questions in the comment section as always. And guys, have a fantastic rest of the week.